Good afternoon, everyone. Welcome to an insightful 50 minutes of Finanz und Wirtschaft webinar within the series of NACHHALTIG Investieren, Fundamente für die Zukunft. My name is Ralf Kretschmer from EBG Investment Solutions in Zurich. We are delighted to support this event also this year as its knowledge partner. Please note that this webinar will be recorded. So as we are meeting here today in Glasgow, negotiations are ongoing to reduce the risk of severe disastrous effects of climate change. We have seen that sustainability and impact have now even reached private equity as a main topic. A recent study of Pricewaterhouse that's come out shows that the main motivation for ESG has now become value creation. We've seen recent crackdowns by the SEC, by European regulators, more stringent regulation coming. So it is now about also going after social and greenwashing. That means real solutions are taking center stage, are in high demand, real solutions that create both return and impact. And we will hear some of those presented today. Let's look quickly at the initial question by the audience. Yes, okay, so we're not, we are more optimistic. I see, that about almost 2/3 of respondents today say that the climate conference will show at least a mediocre result, and about 30% that it will be a disappointment, as in the past, and only 7% are even expecting a positive surprise. I would have thought it's even a bit less optimistic than the respondents here, but let's see how long it takes until the wake-up call really happens. So today we have three distinguished speakers providing us with insight on sustainable and impact investing in Asia and emerging markets, equity and infrastructure opportunities. It's Matthew Jennings from Fidelity International, Nick Parsons from Thomas Lloyd Group, and Natalia Eisele from EBG Investment Solutions. Following the presentation of each, we will have 15 to 20 minutes for questions from the audience and for further discussions. You should have a button below on your screen that's either named F&A or Q&A, and you can use that to submit your questions, which I will then forward to the presenters if you name that they are directed to one of them, or if it's visible anyway. So our first presenter today is Matthew Jennings, Investment Director for Sustainable Investing at Fidelity International. He's responsible for the development of Fidelity's sustainable investing capabilities and is also driving the ongoing ESG integration within its investment process. Matthew has 15 years of investment experience, joined Fidelity about 10 years ago, and he has also covered UK and global strategies, and then helped about 3 years ago to launch Fidelity's sustainable fund range. And he's a CFA charter holder and has completed a CFA certificate on ESG investing. And with that, welcome, Matthew. We'll be presenting on ESG integration in Asia, in equity.
Thank you so much, Ralph, and thank you for inviting me to speak to you all today. It's a really good opportunity. I think it's a very interesting subject that you've chosen. So I'm going to share my screen. I've prepared a few slides to show you. So this, hopefully you can all see this this screen now. I'm just going to make this full size. So is that okay? Can you see the slides, Ralph? Yeah, okay. So this first slide is really just sort of showing you what the starting point is. And the bar chart is showing the distribution of ESG assets across different global markets. And the blue bar is Europe. And so you can see that the vast majority of ESG assets globally are invested in European strategies. And you need to be looking at this chart on a very large screen to see Asia here, because Asia is in the orange bar, and if you can see it at all, you'll see that it's very, very small. So what this means is that, you know, historically, demand for specific ESG strategies in Asia has been fairly low, particularly in comparison to Asia and to Europe and to some extent the US. But we do see this changing now, and we see it changing really quite quickly, actually. And the reasons for that change are, I think, threefold, really. So firstly, public awareness is changing very quickly. Obviously, you know, a lot of this is public awareness of the environmental and social challenges that we're facing. Much of Southeast Asia, many of the big cities in Southeast Asia are particularly at risk of rising sea levels, which of course is one of the main effects of climate change. So we do see a pretty large degree of concern in Asia, and that's filtering through in terms of demand for financial products. And then secondly, and I suppose partly connected to that, is regulation is increasing. We've seen a huge amount of regulation coming through Europe in the past 2 or 3 years. Of course, I'm thinking primarily about SFDR here. And there's nothing in Asia at the moment which is of the same comprehensiveness, but there are some of the Asian financial centers, Hong Kong and Singapore in particular, and some others, are introducing their own ESG regulations, requirements for more disclosure from corporates, particularly around climate risks, for example. And so, they're following some of the same trends as we've seen in Europe, but maybe with a bit of a lag. And the final point here is around legislation, which again is connected to the other 2 points. And what I'm thinking of here really are the net zero commitments that we're seeing Asian countries making. Ralph mentioned that we're in COP26, and one of the things that has come out of COP26, which may have contributed to some people's sense of disappointment that I saw reflected in the questions that were asked there, is some of the targets that have been issued. India 2070 target, China 2060, Japan has a 2050 target. But the point here is that all these countries are gradually aligning themselves to the Paris Agreement in one form or another, and that to achieve those targets will require mobilization of financial markets in the same way that we've seen in Europe. Okay, so the next slide we're looking at is sort of the starting point, really, in terms of what are we looking at in terms of the ratings breakdown in Asia compared to other markets. And I think the reason I'm showing you this is that within the world of ESG ratings, there's often quite a long emphasis on ratings and ESG ratings. And so if you are someone who's very focused on ratings, then there are going to be challenges to ESG investing in Asia, because Asian companies have on average lower ratings than any other major region. You can see here that 90% of European companies have ratings over BBB from MSCI, whereas for Asia that number is less than 50%. So a massive difference there. Albeit there is a broad range of variation between different Asian markets, and that's a theme that we'll return to later in the presentation. The sense of not all Asian countries are alike in this sense. So again, so what I'm trying to describe here, I guess, is a bit of a challenging backdrop for a conventional ESG investor in terms of approaching Asian equities. And some of the specific challenges are shown here on this slide, and I'm just going to pick out a few of the key ones. We don't really have time to go through everything, so I'll just try and summarize a few of them. And so I've already alluded to the fact that regulation in in Asia is at an earlier stage than it is in some other some other regions. We don't see the sort of shareholder protections that we see in Europe, and certainly from a disclosure point of view, we see much less standardized disclosure of ESG data in Asia. But again, the outlook is somewhat encouraging there, because much of the regulation that is coming through will require Asian companies to disclose climate risks in line with the TCFD recommendations. So the outlook is more promising on that front. However, you know, this does remain a big challenge for investors who are reliant on disclosures as an approach of ESG integration. So, you know, our solution to this is to actually go beyond the disclosures and speak to the companies. We can do this because we have 60 analysts on the ground in Asia that have relationships with the companies at Fidelity. So we're able to sort of bypass those disclosures and speak directly to company managements and sort of interrogate them on their ESG practices and really develop a good understanding of what they're up to. So just to give you a really quick example here of a company I was looking at recently, which is held in our Sustainable Asia Fund. There's a company called Titan Wind, which is a Chinese wind turbine manufacturer. So, you know, making a big contribution to the transition towards a renewable energy mix in China. But its disclosures, like many Chinese companies, its disclosures are really quite poor. It doesn't disclose a lot of the data that ratings providers typically look for. So we've had to, you know, interview the company, you know, over successive occasions, get to know them, to talk to them about things like their health and safety practices, to understand their approach and develop conviction in the business and their ESG quality. So that company is rated B by Fidelity, even though it doesn't have a rating from some of the major ratings providers in the market. So then moving on to attitudes. And what this really means is that, you know, you can't take for granted the fact that all management teams and all owners of businesses in Asia buy into the idea of ESG. Some support it, some are doing great work, but not everyone does. There is a real divergence across different businesses. And so again, you really have to understand each company on its own merits. You have to get to know the owners and get to know the management teams to understand what they're prioritizing and what their approach to ESG is. And then finally, this point about know your market. So this is something I alluded to earlier. Within Asia, we think there are 17 investable markets, and this is growing all the time. And across those markets, obviously, we're talking about a large number of different languages, different cultures, market structures, regulatory environments, legal frameworks. So a local presence is really, really helpful here. And again, you know, we've got analysts in Singapore, in Hong Kong, in Shanghai, in India, many different parts of Asia who are from these countries and understand them well. And that's been really helpful for us in integrating ESG into our Asian equities business. Okay, so I'll just finish off with a little bit more detail on our approach to ESG research and how this kind of helps us to solve for some of these challenges that we see in Asia, Asian ESG integration. So firstly, that maybe one of the key differences in our approach to ESG research is that we're actually asking our analysts to combine the role of financial research with sustainability research. We think this is quite unusual, but it produces meaningful benefits because it means that you're not effectively siloing ESG and it's being properly integrated into the investment process. As I suggested before, we're leveraging the access to company management teams that we have, and we're not just relying on the public disclosures that these companies make, because in Asia, quite often they just don't make these disclosures and the information is not available. So that access to management teams is really, really helpful. And so, of course, that kind of leads into the engagement that we do with companies, not just the managers, but also divisional management, lower down the organization, and also non-execs and board members. This allows us to be more forward-looking, again, not being reliant on data. Data is a picture of the past rather than a picture of the future, typically. So our access to company management gives us that ability to be more forward-looking. And I think those are really the main differences. The fact that we go into a bit more detail in our research does mean that we typically are rating fewer companies. We're a bit more focused in our attention, and we just tend to focus on the companies that we're interested in investing in, and more so than the sort of broad coverage that some of the ratings providers that take. So I think the key message I wanted to get across here in my 10 minutes was to describe a picture where demand for ESG in Asia is rising from a low level. But there are challenges to ESG integration that require this kind of country-specific, stock-specific, industry-specific expertise. Good access to management teams is going to produce better ESG outcomes in Asia, and that's our view. And I'll leave it there for the time being. And if there are any questions, then we can return to those later. But thanks, and back over to you, Ralph.
Thank you very much, Matthew. Our next presenter is Nick Parsons. Nick is the head of research and ESG policy at Thomas Lloyd Group. He's responsible for the investment strategy and ESG integration, and he's also the chair of the ESG Stewardship Committee, which was created to oversee the implementation of the SDGs and the reporting. He's also responsible for macroeconomic research, and he has been in similar research roles prior to joining Thomas Lloyd at National Australia Bank, and in similar capacities also with Commerzbank and Banque Paribas. Nick will present the infrastructure in emerging markets, an engine of growth and real impact. Nick, over to you.
Well, thank you very much, Ralph. Ladies and gentlemen, good afternoon. I do hope you can see the slide on my screen here. As Ralph said, I'm Nick Parsons. I'm head of research and ESG policy at Thomas Lloyd, and I'm delighted to be speaking today at this prestigious conference to talk about sustainable and impact investing in emerging markets in Asia. Because here at Thomas Lloyd, we've been investing in renewable energy in Asia for more than a decade, and I'll talk about that in a moment after I've outlined the powerful story of economic and demographic change across the region. First of all, though, I'd like to say on behalf of all our colleagues at Thomas Lloyd how proud we were to be able to announce at the COP26 meeting only last week that the UK government, through its Mobilist initiative, launched by the Foreign Commonwealth and Development Office, has announced it will invest up to £25 million in our new Energy Impact Investment Trust, which is to be launched shortly on the London Stock Exchange. We take this as a huge vote of confidence in our investment strategy, and we're thrilled to be able to share this news with you here. Our target initial fundraise of $340 million will add to the $1 billion already deployed across 16 projects in renewable power generation, transmission, and sustainable fuel production, which makes us one of the longest established and most experienced investors in the region. Let me now try and explain what makes us so excited about those opportunities. If we look at economic performance in the 10 years prior to the COVID pandemic, none of the 30 countries which together comprise the IMF's Emerging and Developing Asia region saw negative GDP growth. In fact, Asia's average growth of 7% a year was the highest in the world. Now, the IMF divides the world into 13 regions, subregions, and categories. So to bring our analysis right up to date and include the COVID recession and the subsequent recovery in activity, we can see that emerging and developing Asia is in #1 spot, the fastest growing region in the world, with an average annual growth rate of 5% per annum over the past 5 years. Compare this with the G7 at just 1.2%, or the Eurozone with a dismal 0.9% growth. Now, along with its impressive economic growth, the Asia region is still seeing rapid population growth. Europe's population has been little changed since 2000, and the United Nations, who are the experts on demographic change, expect this to fall by 40 million over the next 25 years. By contrast, Asia is expected to grow by 650 million over the same period. That's the equivalent of adding 9 Germanys or 80 Switzerlands, and it's forecast to reach 5.3 billion in 2050. In India alone, the population increases by more than 1 million a month, or 37,000 a day. And rather fortunately, here's a picture at International Yoga Day back in 2015 of what 37,000 people in India actually looks like. That is the daily increase in population in the country. Now, that growth in population is expanding the size of India's cities. Already, it has 40 cities which have more than 1 million people, and 6 of these have got more than 10 million. Indeed, Delhi's population is set to increase by 16 million over the next 25 years. And in 2050, Mumbai will have added another 20 million to become the world's most populous city with an incredible 42 million people. Now, putting all this together, economic growth plus population growth plus continued urbanization makes a powerful macro background to our investment case, because economic and population growth have already led to a more than 200% increase in electricity consumption in Asia over the last 20 years. Over this same period, with recessions and slow growth in the Eurozone, electricity consumption here has risen just 7%. Now let's turn to climate change, and specifically to CO2 emissions, which must be reduced significantly if we're to keep global warming to the Paris agreed target of a 1.5 degree increase by 2050. Now in 2019, that's the last year for which we've got comprehensive data available, the world's total emissions of CO2 amounted to just over 36 billion tons. Now, if we look at where these emissions come from, China is the biggest culprit with just over 10 billion tons. Then it's the US with 5.3 and India with 2.6. Adding up the whole of the Asia region gives us 16.6 billion tons, which is almost exactly 1/2 of the global total. At Thomas Lloyd, we've developed a concept called the carbon cost of GDP. Essentially, what we measure here is the CO2 emissions per unit of economic output. Specifically, we look at how much CO2 is produced for every $1 trillion of GDP. We see here the 10 largest economies in the world. India has got the largest carbon cost with 880 million tons for every $1 trillion of GDP, and China is the second highest at 707 million. The key point, though, is to look at those numbers in Western Europe, the numbers in red. The 4 largest economies here have a carbon cost of GDP which averages just 148 million tons. Europe has already undergone a significant behavioral shift. It's got a stable population and very low rates of economic growth. If we really want to shift the dial on CO2 emissions, we have to take action in Asia. Now, looking at the 10 of the largest economies in Asia, their carbon cost of GDP ranges from 880 million tons in India to 338 million in Bangladesh. The regional average of 566 million tons is more than 4 times the average of the 4 largest countries in Europe. So yes, you can all recycle your trash, turn down the heating and switch to an electric car, but it's not going to solve the problem of climate change and CO2 emissions globally. For that, we must address the problem at source. Now, clearly, this is going to require a lot of investment, and with government finances ravaged by the COVID pandemic, much of this is going to have to come from the private sector. G20 estimates that in just 5 countries in Asia, those where we at Thomas Lloyd intend to expand our activities, some $7.9 trillion is required by 2040. That's around $340 billion a year for the next 20 years. Now, at Thomas Lloyd, we've already made a start. We finance, built and operate 6 solar plants across 4 states in India, and a 7th plant is currently under construction in Madhya Pradesh. Together, these will supply clean solar-powered electricity to over 500,000 people and reduce CO2 emissions by over 600,000 tons. In the Philippines, we built the first utility-scale solar plant in the region, and today supply electricity to over 170,000 people, reducing CO2 emissions by more than 65,000 tons. Perhaps our most exciting project, though, has been the construction of 3 biomass plants in the Philippines. These take trash from the sugarcane harvest and use it as fuel to power huge turbines, which produce sustainable, renewable energy. We're especially proud of the impact that our investments have had in transforming lives on the island of Negros. That's the 4th largest of the 7,000 islands which make up the Philippines. This island produces 54% of all the sugarcane grown in the country, and using innovative mechanized processes, we collect more than 700,000 tons of trash every year from the sugarcane farmers. We report to all our investors in quarterly performance reports and annual impact reports. Our job creation has transformed the island, both socially and economically. Jobs bring dignity, family stability, and economic security. The taxes we pay directly finance public works, housing, and welfare programs, and they help drive gender equality. In the space of less than 10 years, the island has gone from a program of rolling blackouts with no power at all to being at peak times a net exporter to the Philippines electricity grid. We've seen the transformation with our own eyes, and we've seen the difference that investment can make. Impact, we believe, comes from investing real money in real assets, making a real difference to lives in the communities in which we invest. It does not come from buying and selling equities in the secondary market, merely shuffling money around and changing the ownership of a share certificate. Ladies and gentlemen, I'm delighted to be here to present to you today. I hope in my 10 minutes, I've given you an idea of the scale and the opportunity and the impact that can be delivered by investing where our money makes a difference. But in just the 10 minutes that I've been talking, another 250 people have been born in India. We need to mobilize large-scale capital urgently and at pace. Thanks very much.
Thank you, Nick, for this interesting presentation. Our next presenter is Natalia Eisele, Investment Manager at EBG Investment Solutions. She's responsible for sourcing, due diligence, and execution of private market investment, entirely focused on opportunities where sustainability is a key driver of both return and impact. Before joining EBG, Natalia was with Suzy Partners within the energy storage strategy as an investment manager as well. And before that, working with UBS in the M&A department. Welcome, Natalia.
Thank you very much, Ralph, and thank you everybody to be here and make time for this webinar today. So my name is Natalia Eisele. I'm an investment manager at EBG. For those that don't know EBG yet, EBG is a specialized investment boutique based in Zurich that invests institutional capital in the intersection of positive impact and returns, and mainly through the private markets, where we see today the biggest opportunity within this space. So EBG has been actually in the market since over 10 years. We invested in more than 30 different investment managers in different sectors globally. And what we can see, and especially within the impact space, is that it's very important to be in the right place in the right time and select opportunities and sectors that differentiate themselves from what you see in the market elsewhere. I think a good example is the renewable energy sector, where like 10 years ago was still, let's say, not mature yet. And for people that enter in the sector back 10 years ago, I think that they were able to profit from a curve in the past. So I would like to share my screen now. Give me 1 second. It's not working. 1 second. So apologize for that. So, so actually, to answer the question, how profitable are clean energy infrastructure investments in emerging markets? It was a quite interesting exercise to answer this question. I come myself from the, let's say, clean infrastructure industry. And what I realized over the past years is that a lot of attention has been given to energy transition in terms of energy production, especially related to infrastructure investments in the private market. And I think that less attention is given or have been given to the other side of the coin, meaning how are you dealing actually with the products that you have in the market, with the materials, how we are consuming the energy that has been generated. And I think that this is where I'm going to focus my presentation today. And I'm going to continue now showing a little bit about the market. So I think that first of all, and also as a, let's say, highlighting what is going on in the private equity market within the green assets industry globally, and also with a focus on Asia. If you look at the Asian market, I would actually have expected, due to the population size, the importance, economical importance of this region in the world have to us, that actually the private equity investments in the sector would be much higher than they are. I think that managers have been focusing more, let's say, globally, as you can see here, $31.3 billion US dollars, while Asia-focused funds are only 4.2 billion. So we can see here that there is a lot of room to increase private capital to be injected in these industries in the future. And on the right side of the slide, you see the pie that shows actually that the private equity investments in green assets in Asia is only 6.6%, while non-green assets is much higher. So also here, it shows like the huge opportunity that we see in this market, and there is also a lot of room to continue investing it in the future. So coming back to material productivity, I think that this is quite an interesting chart, and also it was for me a surprise when I saw this data. So if you see here, since 2000, the material productivity in Asia has been declining. So I think that this is quite controversial if you see today where we are with our CO2 reduction, emission reductions targets, energy transition, let's say, being spoken everywhere, and you see that actually one of the regions in the world that actually is producing the biggest, let's say, waste and in all aspects actually, that they are not really efficiently using the material there. And I think that this is quite a surprise, and actually it should be something that of a huge concern, because some data estimates that if you continue this trend, the global resource extraction will double by 2060, what I believe our planet will not be able to handle. So when you talk about material productivity, I think that something that comes into our mind, of course, is plastic. I think that the plastic industry, it's a huge industry, and also a problem that we have nowadays to deal with that we cannot change anymore. I think that consumers already learn to use plastic and to use plastic as a disposal product in our life. And I think that until we can change this consumption behavior, it's going to take too long. So we should focus on how we can actually solve the problems in other ways. I think that here's some statistics about the plastic industry. So it is still expected to grow 40% in the production in the next decade, what is actually quite impressive and very negative as well. Also, it's expected, we expect 400 billion of investments into new refineries by 2023 in the US, China, and the Middle East. Also, the ethylene, the substance that is used to produce plastic, the market is expected to grow. And actually, if we keep going in this piece, the plastic leakage into the oceans are going to double by 2040. So what does that mean? This means that this market is there. There is this huge growth and production of plastic in the consumption and the production, and we don't have time to wait this to change. I think that we need to deal with the situation that we have now. And why is actually emerging market, but now I'm focusing with Asia, why is that so important or so relevant for us nowadays? So Asia, together, of course, with China, has been producing half of the plastic worldwide. This actually trend is growing exponentially, what is actually quite a huge increase in the coming years. Other than that, in terms of waste generation per capita in mid to low income countries, we can see that we expect this the per capita waste generation to double by 2040. If you consider as well the population size in these regions of the world, this will be a massive increase in the waste generation worldwide. And finally, and I'm not sure if you're aware of that, but China has been importing 45% of all international traded plastic waste since 1995. And from this waste, only 50%, or from this plastic waste, only 15% is effectively recycled. What does it mean? It means that actually Asia is not only producing half of the plastic worldwide, it's also generating huge waste and also importing from other countries to recycle what actually in the end, it's not effectively recycled and ends in our oceans and environment. So where do we start? What is the solution? And most importantly here, and relevant for us, how can we invest in this sector and also participate on this trend? So I think that there is not only one answer for that. I think that if I could choose, of course, I would ban the plastic production, reduce massively the consumption of plastic, but this is not realistic. As I mentioned, it's something that has more to do with the consumer behavior that's going to take a while to take place. So I think that the solution is a series of interventions that need to take place, hopefully at the same time. Some of them are more related to regulations that need to take place, restrictions, others on innovation, technology that needs to be changed in the world. And two of them that is actually where we feel that is a very attractive market in emerging markets today is on expanding the waste collection and also increasing the mechanical recycling capacity. So expanding the waste collection in emerging markets is it's a huge market actually, because nowadays only 39% of our waste, of the waste that they did generate there, is collected. Emerging markets countries as well, they don't have actually the financial resources to, let's say, invest in this infrastructure. The governments, I mean, the public sector, they are not prepared to that. So they require the private sector to enter and inject capital in this infrastructure, and also to bring the technologies that we have here already in place into this market. And by doing so, we can, let's say, generate value as well for ourselves as an investor. On the other side, mechanical recycling is a very interesting sector, because I'm not sure if you know, but you can actually dispose waste in three different forms. You can burn it, you can bury it, or you can recycle it. Recycling is actually the most expensive disposal mechanism, but on the other side, it's the only one that generates revenue. So if you recycle a product, you have a material afterwards that have a certain value. This, of course, for infrastructure investment is very interesting, because you have a revenue generation in some kind, what can make very, very attractive investments. So looking now at our market, I think that here is also, we see that there is a huge, we need to increase the capital investment in the waste and management and recycling industry. What is very interesting when you look at this chart, that is actually based only on private investments in green assets, is that the allocation profile is very different among the countries, especially between the both bigger players in the market. So if you compare China and North America have been focusing on investing private capital into the renewable energy industry, while China has been focusing on the electrical vehicle industry. But what is interesting is that on emerging market Asia region, we don't see actually significant investment and share of this capital being directed to the recycling and waste management industry. And I think that this shows one time more how necessary it is to increase this portion on the pie, that there is a huge potential in this market. And if you look maybe among other type of investments, this is for us where we see, let's say, the small pearl in the market that's going to grow a lot in the coming years. And I think that also it's very important to mention from my side, I believe renewable energy, it's going to be very interesting and very important for our energy transition process. So I think that we should keep investing the same way how I did before, but actually also as a differentiation factor and to aggregate diversification to portfolios in terms of clean infrastructure. I think that the private market should also focus on these different areas, what is recycling and waste management. I think that that's all from my side today. Happy to answer any questions afterwards.
Thank you, Natalia. We've gotten a lot of insightful information. From a high level, I would take maybe three conclusions here, or pre-conclusions. One is we have seen how important that Asia really is. We have also seen how much there is to be done, especially specifically around, but not limited to, the whole climate discussion. And then thirdly, I think as it relates to our profession here, we've also seen all good examples of why active investing is so important. These transitions and these opportunities that we have heard about cannot be invested in through a purely passive approach. And I think that is clearly visible in that. We're now coming to questions from the audience. So again, please, if you have any questions, submit them using your Q&A or F&A button on the bottom of your screen, and then we'll direct them to the presenters. I'd actually like to start off with a question to both Nick and Matthew, and that is about how you deal with the uncertainty of, the biggest market being China, in respect of government interventions that can only to some extent, probably if at all, be foreseen. We've experienced that in the more recent past, where certain sectors or certain business models, and with that, were heavily influenced by government decisions. How do you work with that particular part of uncertainty in such an important market?
Should I kick off with that one?
Yeah, that's fine.
Well, we do not directly invest in China. And the reason for that is we don't believe we have a compelling competitive advantage, and we don't have the local partners who are so necessary for the development of our business model. We think there are other enormous and very exciting opportunities elsewhere across Asia, and our 6 target markets don't, for the moment, include China. So we think there's plenty of growth opportunities elsewhere. It does dominate the region in some respects, but we see that both from a legal and regulatory and a partnership perspective, that we don't have the necessary skills that we believe we require to be in a really strong position in that market, and we'd rather deploy our capital elsewhere. We'd rather spend our money where it makes the biggest difference and where it generates the biggest impact. So I'm kind of answering in the negative, that we avoid China. We don't directly invest there because we believe that our capital will make a bigger difference elsewhere across the Asia region.
Well, I guess, uncertainty is a sort of permanent feature of investing, whichever market you're investing in. I think you're right to highlight the kind of maybe increased political risk in China, certainly in comparison to maybe what we're used to in Europe. But you know, there are political risks to investing in some European markets too. So, well, I think one sort of general principle that is helpful is, you know, consider the degree to which the companies that you're looking at are contributing to the aims of the Chinese government. And you know, so for example, I gave an example of a wind energy, a wind turbine manufacturer, and we know that, you know, the development of that sort of technology and the rollout of it is essential for meeting some of China's targets with respect to growth in renewable energy. So I think the general activity that the business is involved in will give you a clue as to how likely the government is going to be to sort of intervene or not. But of course, there's no guarantee. And I think, you know, that, so again, this is an argument in favor of sort of portfolio diversification, not putting all your investments in the same market with the same regulatory and political risks attached to them, but running a sort of more diversified approach. I guess that could be a second sort of way of managing that risk.
There's another question from the audience, I guess for Nick. What is your position on using lobbying and working with the authorities to promote the required infrastructure investment and facilitate transition?
Well, I think we must work together with the authorities and work in tandem. We must work in a spirit of cooperation and partnership. And it was through that, and through that also through open and transparent competition, that we were able only last week to announce our success in the UK's Mobilist programme. Direct lobbying is, I think, a very tricky area. We abide by all the PRI principles in this, and any activities we were to undertake would be fully disclosed and be fully transparent in all the disclosures that we make. But frankly, we believe that actions speak louder than words, and we prefer to be judged on our track record, and our track record of almost 10 years of investing in sustainable renewable energy infrastructure across that region really does mark us out as someone who's done it. We've done it, we've got the experience, and we can talk about it from a position of some knowledge. And we prefer to be judged on our actions rather than necessarily on lobbying, whether that's directly or indirectly, because we believe that actions speak louder than words.
That was a statement. Thank you. And Natalia, why do you expect that private market managers, private market investors and managers will start focusing on waste management and recycling infrastructure in emerging markets, particularly Asia?
Yeah, that's actually a good question. I think that it took a little bit too long, from my perspective, for let's say the private sector to realize the importance and also the attractiveness of this market. And I think that while 10 years ago the focus was more like renewable energies, I think that slowly, especially through the plastic industry that is causing a huge noise lately, especially in Asia as well, due to these plastic islands that are growing and growing like without any control there. I think that now the governments, but also the private market is looking at it and understanding that is to be a shift there. And I think that there is another small factor that, or actually probably a significant factor that's helping it. So China used to, as I mentioned before, so China used to import a big part of the plastic waste worldwide. And lately they actually banned some of these import agreements that they have with the Western countries. And because of that, other countries in the emerging markets in Asia, like Taiwan, Thailand, Philippines, India, they open the market for this import. So there is much more plastic waste and waste in general going to these countries. So they now require even more than before this infrastructure to to be able to digest this new market that is growing there. And since the government and the public sector doesn't have the financial capacity to it, the private market will enter in it.
There's another question, you know, it's about the consumption side. So the question is the emissions per GDP that we saw, do they take the export import or actually the consumer into consideration? So we saw all these huge stacks of carbon intensity at the end of the GDP. But you know, if that's then being exported, shouldn't that be actually allocated to the consuming countries? How do you see that? Maybe for Matthew to start with.
Yeah, I mean, I guess so. This is pointing to the fact that a lot of the manufacturing processes, I suppose, that support consumption in the West take place in developing markets, and they're more carbon intensive, and that's why some of the economic activity that sort of takes place in those markets, you know, by comparison, looks to be associated with higher emissions. So, I mean, I think that's just something that, you know, we need to keep in mind as we think about these targets that these countries are issuing, and what we should expect from them, and what's fair to expect from them. I mean, you know, we're bottom-up investors, meaning that we're investing in companies primarily, rather than, you know, assessing countries and governments and things like that. But I think it's a very fair observation, and something that we can all sort of benefit from keeping in mind. I think Nick might want to come in on that.
Perhaps I could add just briefly to that. I think it was incredibly hypocritical of the Western Europe and North America to claim credit for reducing CO2 emissions, if essentially what it's doing is offshoring the problem. So if we close down polluting industries in Western Europe, and then we simply provide finance to have manufacturing plants done in Asia and elsewhere, then that doesn't solve a global problem. It might solve a local problem, and it might create some very nice political headlines. But it's kind of the law of unintended consequences, that as we try to undertake behavioral shifts in Western Europe and elsewhere, that we're not really solving the problem. And to some extent, I think the same charge can be leveled against public equity markets. Public equity markets have been very good recently at actually strangling the flow of capital to fossil fuel industries, whether that is oil and gas or whether that's coal mining. And we hear a lot about how the supply of finance has been reduced. The supply of public finance has been reduced. What we don't hear so much about is how the supply of private finance has increased, and has increased dramatically. So if all that we're doing is shifting these companies from being public companies subject to the scrutiny of public markets into private hands, away from all that scrutiny, then we haven't really solved the problem at all. All we've done is disguised it, we've hidden it, we've buried it under the blanket somewhere else on the other side of the world. So I think we've got to be very careful about the laws of unintended consequences. And I think we have to be very humble in terms of the credit that we can take for our emissions reductions in Western Europe, and also the extent to which we've managed to somehow green listed equity portfolios by reducing the supply of capital to them. It's not really a success if all that happens is that private capital moves in to take its place.
Yeah, I completely agree with that. Just sort of taking the part of equities for a moment. I think this advertises the limitations of exclusions as an investment strategy for an equity investor. Actually, our preference is not to take a sort of broad brush approach to excluding certain sectors, but to try to engage with management teams and to keep a seat at the table and to drive them towards the right sort of actions that will have these sort of long-term outcomes, rather than, you know, as Nick was saying, push them into private markets where disclosures are going to be much lower and potentially run for shorter term interests.
You know, in that regard, or in connection with that, and a last question I see for Matthew. What do you do if there is a governance controversy in one of your holdings? How is this then being dealt with at Fidelity? And are there situations where it would automatically lead to sale from your portfolio?
Yeah, I think it's the answer to that question follows a bit from what I was just saying, in the sense that when something goes wrong in one of our investments, we don't tend to take a sort of automatic knee-jerk reaction to selling the position, but we prefer to engage with the management team to understand what's happened, to understand if on a forward-looking basis we can expect things to improve. Is there something that we as shareholders can do to improve, you know, if that's governance related, for example. And then, you know, so it'll be a very, very case-by-case assessment of what's happened and what we can expect going forwards. That's the way that we'd approach those sorts of issues.
Thank you. So we're coming now to an end to the end of this webinar. I think we've heard a lot today of markets that are not so close to most of us, simply also from a regional perspective, but which offer tremendous opportunities. We've heard about trends. We've also been introduced to really actionable investment opportunities that people can invest. I would encourage the audience, if you have more questions, to reach out to the presenters. Also, if you would like to speak to them with privacy, just follow up on these presentations. I'd like to take the opportunity to thank Matthew, Nick, and Natalia for these insightful presentations. And I would also like to thank the F&W team for their support and technical support and making this all possible. And with this, I wish you a very nice evening. Bye-bye.